measuring success. Mine is bigger than yours. Stay motivated, not long to go now before you understand a key concept in deciding if a stock is worth your money. We should now look at earnings per share. This is your vital weapon of mass destruction for fighting the war against flushing your hard-earned cash down the toilet. So here is a little challenge to get us into the swing of things. To recap, the earnings are the revenue of a company minus the expenses that company has incurred. And the earnings per share are the company's total earnings, so everything they have earned, their profit after tax, divided by the total number of ordinary shares outstanding in the marketplace. So that profit divided by the number of shares equals the earnings per share. So the EPS challenge, earnings per share, which is better? Company A, Big Balls & Co., Leather Balls Manufacturer. Stock price, $150. So, in the US, earnings are reported on a quarterly basis, and then you have the end of full year earnings. So, for Q1, which is quarter one, the EPS for Company A was $1.50. Quarter 2, they made 10 cents per share. Quarter 3, $1.50 per share. And quarter 4, $2 per share. Company B, Small Spanners Incorporated, a tool manufacturer. Both of these companies are completely made up, by the way. Stock price, $10. Quarter 1 EPS, 20 cents. Quarter 2 EPS, 30 cents. Quarter 3 EPS, 60 cents. And quarter 4 EPS, $1.50. You may be tempted to say, well, Company A have a bigger Q4 EPS of $2 and has made $5.10 for the year. Company B has only made $3 for the year and has a lower Q4 EPS. However, the key to fantastic stock price upward movement is accelerating EPS. Now let's look at the table again to review what the percentage increases in EPS were for both companies. My recommendation of which company is better would be for Company B for the following reasons. Company B is consistent. Unlike Company A, Company B shows strong, solid, consistent growth without interruption. So if we have a look here, we can see the EPS. And remember we said EPS growth is key and EPS acceleration is very important. So Company A, you can see from Q1 to Q2, their earnings per share dropped 93%. And for Q3, based on the same quarter 1 year ago, the earnings per share increased by 1,400%. And in Q4, EPS dropped by 50%. However, Small Spanners Incorporated showed a Q2 EPS growth of 50%, then Q3 100%, and Q4 183%. This is typically accelerated earnings, and that is exactly what Mr. O'Neill is referring to in his book. Also, Company B's combined EPS, $2.80, is equal to 28% of its share price, a very profitable concern. If you add these up, they equals $2.80, and the company's stock is worth $10 a stock. So we add each quarter of EPS for Company B, 170 plus 60 cents plus 30 cents plus 20 cents, which of course equals $2.80. We can divide that by $10 to get a 28% earnings. And if we look at Company A, we can see that if we add 150 and 10 and 150 and 75, we get $3.85. And $3.85 divided by $150 per share equals a measly 2.5% earnings return. So for that reason, also, Company B would seem to be more profitable. Also, Company A had a drop in earnings from $1.50 to 10 cents, a 93% drop, which, unless this is seasonally expected, this shows the company has had some financial difficulties or some issues around sales and marketing and revenue generation. Although Company B shows smaller EPS in Q4, next year, at this acceleration, it would by far exceed Company A. So let's move on to a practical example. Here's a stock chart of Microsoft Corp, ticker MSFT. You can see here this chart is plotted from 1987 through to 2004-2005. And we can see here that if you had invested $1,000 in 1986 in Microsoft, who had very strong accelerated earnings, they're really the poster child for accelerated earnings, then in 13 years, you would have been a multi-millionaire. Your $1,000 would have been turned into $6.72 million by the turn of the year 2000. These signs here show how many times the stock has split. That means the company would essentially halve or divide by 3 the company share price to keep it more purchasable. And then if the price was halved, then they would double the amount of shares in circulation, for example. There are many examples of stocks like this in Mr. O'Neill's book. In fact, his statistics bear out that this is a perfectly valid strategy. And he said stocks that show accelerated earnings in the 6, 8 or 10 quarters before the major price advance have in general exploded and become the new leaders and huge profit potential stocks of the future. So how can we spot stocks with accelerating EPS? Here is an example of SQM, a Chilean producer of specialty plant nutrients and chemicals. It shows absolutely solid earnings quarter on quarter, year on year. You can see here the earnings are plotted over the chart. And we can see here that the earnings growth rate of SQM was through 2008 growing more and more. You can see it here, then getting bigger. You can see the growth in earnings there as percentage terms growing faster and faster. And you see here, and then a huge step change here. Of course, SQM was caught by the crash of the financial crisis, of course, being very heavily commodity and minerals driven. Then the subsequent downturn of the value of commodities has affected it quite badly, and its prices subsequently capsized, dropping from $16 to $15. That's an incredible drop in the worth of the company, almost 75%. However, look what's happened to earnings. Absolutely fantastic. The earnings have grown hugely during this downturn, so it hasn't yet affected the company's revenue potential. And you can see here the stock price starts to recover from $15 to $30 per share, which even is a tiny recovery, yet that's equal to 100% stock price increase. So you can see here the stocks with extremely strong earnings are going to be the first to rebound and rebound extremely strongly during these period of economic downturns. So I hope this helps you to understand one of the most important fundamental measures of a company and how important it is. If you get tips from your financial advisor, postman, workmate, or pals on Facebook, you can now simply look at the EPS and the EPS Acceleration and decide for yourself if the company meets the Accelerating EPS challenge.
Wow, you're still here. Well, I guess you must have liked this video. If you did, don't forget to hit the like button. It will really help the channel out. And click subscribe if you want to be notified about future stock investing lessons, strategies, and software videos. Finally, don't forget to leave a comment or question below, and I will reply.